Now, as the two-year Treasury climbs to its highest level in 3 months, many investors are ducking into bonds. They're looking for a safe haven, but could playing it safe have some hidden dangers? Let's get right to the floor show to find out where investors should be putting their money. Joining me right now here in studio, Great Hill Capital Chairman Tom Hayes. Tom, you say that the pain is being in safe, secure bonds, and that the storm that everyone's waiting for has already passed. What?
That's right. When everyone's crowded to one side of the boat, Cheryl, it usually doesn't work out well. Managers are the most overweight bonds relative to stocks than they've been since the pandemic lows in 2020 and the great financial crisis lows in 2009. And we both know that was a time to buy equities, not bonds. The reason we know this is that since 1950, every cycle, the stock market bottoms 6 to 9 months before earnings bottom. So even if you're pessimistic and you think earnings are going to come down a little bit, that October bottom may be in. We're up 18% since then. And what we find is that you could miss the next move higher. The pain of being in bonds is the negative real yield, which is negative 1.5% after inflation. And then the second bit of pain is what if we continue to climb that wall of worry? We discounted the slowness in 2023 and 2022 with the stock market crash. We're going to discount the strength of 2024 earnings recovery in 2023, and I think people are underestimating that right now.
You know, I've heard this line of thinking and this argument before because every CEO in Davos in particular was saying recession, recession, recession. Well, maybe you're talking yourself into one, or because consensus says a recession is happening, maybe it does not. Does the technical word recession worry you at all, or you're more interested in the fundamentals of the market right now?
Well, we did have a technical recession in Q1 and Q2 of 2022, and I think any pain that people are worried about right now, with a 25% peak to trough correction in the S&P last year, a 35% peak to trough in the NASDAQ correction, that priced in a lot of pain for this year. So as we look out to 2024, S&P earnings estimates, Cheryl, are $250, which means we're only trading at 16.5 times forward earnings right now, and there's a lot to do. There are a lot of things, high-quality businesses that got beat down last year that are still values at this level.
There are some positives that we got this week, and we had a lot of econ data across this week. Initial jobless claims come in, still around that 200,000. I think it's 190,000 is the 4-day moving average, but core retail sales for January, that came in strong. The home builder sentiment survey, that actually rose 7 points. And then you also have the small business optimism index that actually rose, which to me flies in the face of those that are saying that we're going into a downturn, run for the hills, sell your stocks, go into bonds. And you seem to be agreeing with that line of thinking as well.
Yeah, I mean, you saw the jobs report, Cheryl. You saw the retail sales. You saw the new autos in January up 5.9%. People are moving on. And the interesting thing is, the concern is, oh, my goodness, if the economy is so strong, the Fed is going to keep at it. Well, the issue is the economy is handling it pretty well. So even if we do another 25 basis points or maybe even 2 25 basis point hikes, the market is handling it, the economy is handling it, and it's going to look forward to those 2024 earnings moving forward.
The bears will tell you that inflation and the inflation story, and we had CPI and PPI this week, that is why the Fed is going to continue to not just raise rates, but really keep raising rates to the end of the year. In fact, a bear would tell you right now if they were sitting here, and I'm not one, but I'll repeat what their sentiment is, that we're going to see rate hikes to the end of the year, and that overall, that means that this market is not going to recover until 2024 because of the aggressiveness of the Fed.
I've got one better for you. From 1995 to 1999, the Fed funds rate was over 6.5%, and people said tech could not perform with a high Fed funds rate. Well, look what happened. We had the biggest bull market run in tech at a 6.5% Fed funds rate from 95 to 99. So even if we go another 25, 50, we're going to be okay. And the interesting thing is those sectors that everyone told you not to be in last fall, tech, communication services, consumer discretionary, those are the top 3 performers this year, and we like them moving forward. There's a lot of...
You like tech, which is because there's been a lot of pressure on tech. They say that it's all about value and not to growth. And I actually want to bring in Fitzgerald Group Principal Keith Fitzgerald. Keith, thanks for joining the conversation this afternoon. And we're talking about the Fed and the economy. Now let's get into sectors, because there's a lot of bulls out there that say that we should be invested in tech. Tom is one of them. Is that a sector that you're looking at right now?
Absolutely. I couldn't be more strongly in agreement with that. The laggards become the leaders when people least expect it, especially under conditions like we're facing at the present.
And Keith, overall, I mean, I know that you've got some picks. You also have a very interesting take, I think, in whether or not we should be investing in China right now, because you've got some that say that we should be avoiding China because of obvious, whether it's a spy craft balloon in the air or because of the CCP spying on Americans. But then others say that that's where the growth and the opportunity financially is going to be. What do you say to someone that comes to you and says, I want to invest in China?
I say you need to think about two things. The dragon is coming to dinner on Tuesday. Do you want to be at the table or on the menu? And what I mean by that is you can invest in China directly, which right now is a dicey proposition, or you can invest in the world's best companies because of China. I think China is like throwing a rock in the pond. You need to look at the ripples, not the rock.
All right. Well, Keith, obviously, if we are going to move money into the U.S. market, give me one sector you like, and then we'll run.
Defense stocks, very obvious, very complicated place in the world today. Long way to go with those things. Big dividends for most of them.
A Lockheed Martin type of story is what you're talking about.
That is the company that's at the top of the food list as far as I'm concerned.
Gotcha. And there's Lockheed Martin. You also like, Mickey D's. I got to throw this out before we leave. You got to love the French fry.
I love McDonald's. It's a tech company that happens to make hamburgers. I mean, this is the beautiful thing. Sales are going up, revenue per menu is going up, the errors are going down, automation is coming in. It's a fabulous company. Again, long way to run. People don't see it coming, but it's going to pay off.
A tech company that makes hamburgers. Not sure we can go any further with that one. That's a good one. Keith, thank you. It's good to see you. Keith Fitzgerald, Tom Hayes here in studio. Thanks, guys.